So one of the interesting things about the last 2 or 3 years where we've seen yields rising is that the asset class, yielding now 5 to 5.5%, competes quite well with other asset classes, such as equities. If you were to offer equity investors 5 to 6% a year over the next 20, 30 years, most people would take that. But now you don't have to go to the equity market to get that sort of return. In fact, you can get it from the credit market, where you're not taking exposure at the bottom of the capital structure, the first loss piece of any companies. You're actually at the top of the cap structure. So it's a lower risk way to earn a relatively attractive return. We see that playing out in the technicals, the technical demand for the asset class being quite good. There's lots of all-in yield buyers who look at this, whether they're pension funds or private wealth, and will take the view that, now that yields are attractive, all-in yields are attractive in IG, that's a place to allocate capital. So even though spreads are tight, that combination of high yields and tight spreads is creating quite a powerful demand for the asset class relative to other asset classes and compared to where we've been in history, maybe 5, 10 years ago when we had the zero interest rate environment. So the two top-down risks that you can take in a credit portfolio are duration or credit beta. So duration of the portfolio measures the portfolio's exposure to interest rate risk. So if we feel like yields are going to fall, we would have a long duration position. If we felt like yields were going to rise, we would have an underweight or a short duration position, which would protect capital in that rising yield environment. Credit beta, on the other hand, just looks at the spread component of the all-in yield in a credit portfolio. And it helps manage the direction of credit spreads. So if, for instance, we felt that credit spreads were going to tighten, we could have a long credit beta position. And then if that was to play out, the portfolio would make more capital gain than the benchmark in that environment. Conversely, if spreads were to widen, we would want to have a short credit beta position, which would protect the portfolio's capital against any loss from the spread widening environment. We're actually in a very good space today, fundamentally, in the asset class. So, we have a team of 19 credit analysts who cover, 30 to 40 names each. For every name we cover, there is a 2-year forward-looking financial model. We can take all the data from those financial models and aggregate it up, revenue, margins, earnings, cash flow, capex, etc. And what we see for the credit market is that, leverage, so the balance sheets that you're exposed to when you invest in credit, leverage has never been lower in EMEA. And in the US, corporate leverage is as low as it's been for 10 years. When our analysts do their forecast, they're actually predicting or forecasting that corporate leverage stays at this strong level. And so without that corporate leverage kind of spiking wider, it is difficult to see, spreads kind of moving aggressively wider as well. On the bank side of the corporate credit market, which is around a quarter of the market, we also see banks in really, really good shape. So bank capital in Europe and Asia is around 15%, core equity tier 1 is around 15%, and in the US it's around 13% and building. And as far as asset quality goes, our analysts are forecasting that to move sideways. So the fundamentals of the credit market are in very good shape. So we think an active approach is essential in investment grade. IG indices are based on debt capital weighted. So the biggest issuers in the industry, in every index, are the ones that have the greatest amount of debt outstanding. Also, if you were to own the index in investment grade, you own all downgrades. So you own all defaults and you own all downgrades to non-IG. So we believe the best way to begin to outperform in credit is to avoid loss or avoid capital deterioration, either associated with default or with rating downgrades. And if you take an active approach, we, supported by our analyst team, can identify names that we believe are deteriorating or at risk of capital loss, and we can avoid those. The second thing is that we can take risk based on issuer selection rather than those top-down risk factors I was talking about, like duration or beta. Now, if you think about duration, the risk that you take around the direction of yields go up or down, it's a binary outcome. It's the same with the direction of credit spreads. Compare that to selecting from 2,000 issuers in global IG and 16,000 securities. We have a much better chance of identifying mispricing and putting those mispriced risks into client portfolios, which should help us to outperform more consistently over time.